Yesterday, silver didn't just pull back. It got hit in broad daylight, right on the screen, right in front of everyone, and the move was designed to do one thing: make you hesitate. A fast paper dump, a sharp red candle, a wave of panic posts, and suddenly the crowd starts whispering, "Maybe I should wait." That's what happened. But here's the part nobody is saying out loud. While the chart was bleeding, the real-world cost to actually buy metal was not getting cheaper. Dealers tightened limits, premiums stayed sticky, and the so-called discount turned into a mirage. The trap isn't the dip. The trap is thinking the dip guarantees access. I'm John A.G., and you're watching the Currency Academy. If you're sitting there praying for a clean dip so you can buy the bottom, I need you to understand something before you waste another week. In a tightening silver market, a paper dip does not guarantee a physical discount. The screen can drop $5 and your checkout price can still rise. And if you've never lived through a real squeeze, you don't realize how quickly that happens. Because there are two games being played at once. There's the paper game, where banks can slam contracts in seconds, flood liquidity, trigger stops, and manufacture fear. And there's the physical game, where ounces have to exist, refineries have to run, mints have to stamp, and dealers have to ship. Paper can teleport. Metal can't. And when the paper price lies, the physical market tells the truth. It whispers at first, then it screams through premiums, rationing, and back orders. So when you see a sudden smash, you have to ask the only question that matters. Did the world suddenly find millions of new ounces overnight? Or did someone just hit the sell button on a pile of promises? Now let's get brutally practical, because your time matters. This week wasn't quiet. It was violent. Gold ripped higher in raw dollars. Silver surged in bursts that made spreads widen and made late buyers chase. And then, right when the crowd started to feel confident, the market snapped back with one of those intraday gut punches that makes people question everything. And I want you to notice where that volatility is happening. Not near the floor, not near some forgotten low. It's happening near the roof, at extreme levels, in a zone where most traders are emotionally fragile. That's not an accident. That's where shakeouts work best. That's where the "I'll just wait" crowd gets formed. Here's the pattern. First, price rips and everyone feels late. Then it drops hard and everyone feels smart for waiting. Then it rebounds and the waiters feel late again. That emotional loop is how opportunity gets stolen from people who need certainty before they act. And silver is famous for punishing perfectionists. It doesn't trend politely, it gaps, it spikes, it moves on thin liquidity, it moves when you're asleep. It moves when markets are closed. It moves when your broker is lagging and you can't click fast enough. So the phrase, "I'll buy next week," is often just a softer way of saying, "I'll buy after it feels safe." Metals never feel safe until after they've already moved. Now I'm going to make a claim that sounds simple, but it will change how you see every dip from this point forward. In a real bull phase, the price is not the headline. The availability is the headline. The premium is the headline. The delivery time is the headline, because when supply tightens, the market stops rewarding patience and starts rewarding positioning. So let me paint you a scenario, not a prediction, a scenario. Paper silver drops $4 because a wave of contracts hits the market. Social media celebrates. "Sale!" people scream. Then you open dealer sites. You see limited stock. You see delayed shipping. You see premiums higher than yesterday. You see larger bars back ordered. You see the only options left are high premium pieces that nobody wanted last month. That is how a tightening market behaves. The discount is a mirage. And if you've never tried to buy metal during a hot phase, let me warn you now. The screen price becomes a suggestion. The real price becomes whatever it costs to get an ounce into your hands. That is the difference between watching silver and owning silver. And yes, some people will say, "Fine, I'll just buy an ETF and avoid premiums." That can work for trading, for liquidity, for quick exposure. But don't confuse a claim with the thing itself. Paper exposure is a contract. Physical is an asset. In a calm world, that distinction feels academic. In a stressed world, that distinction becomes the entire point. So decide the job. If your job is to trade a move, paper can do it. If your job is to protect purchasing power, to own something that isn't a promise, then you need real metal. And you can do both, but you can't pretend they're identical. Now, let's talk about what the mainstream narrative always does, because they run the same playbook on you every cycle. When metals rally, they ignore it. When metals keep rallying, they mock it. When metals surge, they explain it away as fear. Then, the second there's a dip, they declare the entire move was a bubble and you were the fool for paying attention. Their goal is not education. Their goal is paralysis. Because a confused investor does nothing. And doing nothing is the easiest state to control. So if you want to stay ahead of this, stop consuming headlines and start watching mechanics. Watch the flows. Watch the spreads. Watch the way the market reacts to bad news. In weak markets, bad news breaks price and it stays broken. In strong markets, bad news creates a wick and then the buyers come back quietly, relentlessly, like gravity reversing. That is what strength looks like. Now, I'm going to connect something for you that most people miss. Metals don't wait for official announcements. They move ahead of them. While the media obsesses over backward-looking inflation prints, metals are already pricing the next chapter. That's why commentators always sound surprised. They're reading yesterday's report while the market is watching tomorrow's risk. And what is the risk right now? Confidence. Confidence in policy, confidence in leadership, confidence in the central bank, confidence in the fiscal path, confidence that debt can keep exploding forever without a cost, confidence that the system will stay stable because it has always been stable. History laughs at that confidence. A currency can be widely used and still be quietly devaluing. Reserve doesn't mean invincible, it just means dominant for now. And the long-term driver behind gold and silver has never been a single headline. It has been arithmetic. If you expand the supply of currency faster than real productivity grows, that currency buys less over time. Not ideology, math. And when money buys less, hard assets priced in that money tend to rise. That's the ancient signal. That's why gold and silver exist in the first place. They don't require you to trust a promise. They don't require you to believe a politician. They don't require you to hope a spreadsheet is honest. They just sit there. Now here's where silver becomes the wild card. Gold is the steady signal. Silver is the amplifier. When silver starts moving like this, it often means the market is shifting from hedge to scramble. And the scramble doesn't happen when everyone agrees. The scramble happens when nobody agrees. But the ounces start disappearing anyway. And don't underestimate how fast that can accelerate. 1 week, you have plenty of choice. The next week, the popular bars are gone. The week after that, you're paying up or you're waiting. That's how fast the pipeline can tighten when demand spikes. So I want you to answer this in the comments because it tells me exactly where the crowd is mentally. Are you buying silver at these levels? Or are you still waiting for the perfect dip? Type buying or waiting. Now let's go deeper because the miners are telling you a story too. People keep asking why mining stocks get slapped around on intraday metal dips, even when the bigger trend looks strong. Here's the truth. Miners are businesses, and businesses trade like leveraged bets on the metal. When the market is uncertain, miners get sold first, because weak hands always sell leverage before they sell the core. But that selling isn't always fundamentals collapsing. Often it's forced selling, repositioning, and disbelief. It's the market admitting it still doesn't fully trust the new price regime. And when belief finally catches up, that repricing can be violent. Because mining profit is not linear, it's a switch. Imagine a miner with all-in costs around $25. At $30 silver, the margin is thin. The business feels fragile. At $60 silver, the margin becomes thick. At $90 silver, the business turns into a cash engine. Every additional dollar above the cost line flows into cash flow like a river breaking a dam. Price goes up 2x. Profits can go up 6x. That's the leverage everyone talks about, but almost nobody actually models correctly because Wall Street loves comfort. And comfort comes from anchoring to old assumptions. They build normalized spreadsheets. They assume mean reversion. They call extreme prices temporary. That makes them feel smart. But mean reversion is not a law of nature. It's a habit of history that breaks in regime changes. Now, I need to be clear about something so nobody misquotes me. Physical silver is a store value play. It's ownership. It's no counterparty risk. Mining stocks are riskier. They can be mismanaged. They can be diluted. They can get hit with political nonsense. They can get shut down. So you size them differently. You don't treat them like metal. You treat them like an aggressive lever. But risk and reward are connected. And what I see right now is a market that still hasn't fully priced the reality of elevated metals, which means mispricing still exists, which means opportunity still exists, which also means the next move can be faster than you think. Now here's a detail that blows up a lot of simple narratives. Many gold miners also produce silver as a byproduct. That means when silver is ripping, it can lower their effective costs. It can fatten margins in ways analysts ignore until earnings force them to update the model. So you can have a gold stock benefiting quietly from silver strength, while the headlines pretend silver is just a shiny toy. This is why information edges matter. Now, before we keep going, I'm going to drop the most important community message right where it belongs, in the middle of the action, not at the end when people click away. And don't forget, subscribe to support the original work. And if you're part of the movement against copycats, comment John A.G. Best so I can see you. Now back to the core story, because we haven't even hit the scary part yet. The scary part is not that silver is high. The scary part is that volatility is clustering at highs instead of collapsing. That usually means the market is fighting over a new base, not rolling over into a new bear. You're seeing stress tests at altitude. You're seeing attempts to shake people out. And you're seeing buyers step back in anyway. That is a sign of a transition. And transitions are where the biggest money's made, because most people can't emotionally handle them. They either chase the top and panic sell the dip, or they wait forever and buy only after the move becomes socially acceptable. But markets don't reward social acceptance. They reward early conviction. Now, let's talk about the word everyone throws around like it's a magic shield. Inflation is cooling. Be careful with that phrase. It is designed to comfort you. A lot of times, the year-over-year number looks better because you're comparing against a past spike. But if monthly inflation is still running hot, the problem isn't solved. It's just less obvious in the headline. It's like saying the fire is under control because the flames are lower while the house is still burning. And here's the real trick. Even if official inflation prints look manageable, the lived reality can be worse. The basket changes. Substitution hides pain. Packages shrink. Quality drops. And asset inflation gets treated like it doesn't matter, even though it decides whether you can afford a home, whether you can afford insurance, whether you can build a life. That disconnect is gasoline for metals. Because when people realize the numbers don't match the feeling, they stop trusting the story. And when trust cracks, they look for something that doesn't depend on trust. Gold and silver are that something. Now add the currency layer, and this is where it becomes a thriller. When your currency buys less abroad, imports cost more at home. That's not a political statement. That's a basic conversion problem. And the more global your life is, the more that matters. Electronics, energy, materials, food, machinery. If the currency weakens, the world becomes more expensive. That is what people are feeling as an affordability crisis. It's really a purchasing power crisis. Now, you will hear people celebrate improving trade numbers, but you have to ask improving how. If imports fell because prices got too high, that's not strength. If the improvement came from shipping out hard assets, that's not a production boom. That's liquidation. That's selling the family silver to pay this month's bill. And when a country liquidates assets to look better on a report, it is a warning sign, not a victory lap. Meanwhile, global sellers don't stop selling. They just find other buyers. So your pain becomes someone else's gain. Your consumers pull back and someone else steps in. The world keeps moving. That's why the currency story matters for metals. It tells you who is getting squeezed and who is escaping. Now, silver has one more twist that makes it uniquely explosive. It's small. The silver market is thin compared to global money flows. It doesn't take much institutional allocation to move it. And institutions don't buy like you. They don't drip in slowly. They allocate, they rotate, they rebalance, they stampede when narratives flip. And when that stampede hits a thin market, pullbacks become wicks, dips become memories, discounts become stories you tell people later. So if your plan is to wait for the perfect pullback, define what you actually mean. Do you want a slightly lower spot price? Or do you want the ability to buy physical at normal premiums, in normal size, with fast delivery? Because those two are not the same. And the longer this move persists, the more those paths separate. Now I want a second comment prompt, and I want you to answer it honestly because it reveals your strategy. What are you buying right now? Physical silver, mining stocks, both, or neither? And why? Here's the aggressive truth. A lot of people aren't waiting for a better price. They're waiting for permission. They want the media to say it's okay. They want the crowd to confirm it's real. They want the move to be obvious so they don't feel stupid. But the moment it becomes obvious, it becomes expensive. That's how markets work. Now, does this mean silver can't dip? Of course it can dip. It will dip. It can dip violently. But the question isn't whether a dip can happen. The question is whether the dip will offer you what you think it will offer you. A clean entry, low premiums, full availability, no delays, no friction. And in a tightening environment, friction is the tax you pay for waiting. Now, the next chapter is where things get serious because the ultimate risk isn't a consumer credit event. It isn't a mortgage crisis. It isn't even a bank wobble. The ultimate risk is sovereign debt, a government credit event. Because when consumers go broke, you can blame them. When banks go broke, you can bail them out. But when the balance sheet at the top of the system becomes the stress point, the escape routes get ugly. And that's why metals matter. They're not just a trade. They're an exit from a promise-based system. And here's the cliffhanger I want you to remember when you see the next smash. If the next crisis centers on sovereign credibility, not private leverage, then the safe asset narrative changes. Portfolios get reorganized. Money moves out of paper certainty and into hard scarcity. And when money moves, it doesn't tiptoe, it rushes. So don't let a red candle hypnotize you into paralysis. Don't let a paper smash convince you the story is over. Watch the physical signals. Watch the premiums. Watch the inventory. Watch the miners' behavior. Watch the volatility at highs. Because those are the tells. And if you got value from this breakdown, do the simple thing that keeps original work alive. Subscribe, leave a comment, and tell me where you stand. Buying or waiting? Physical, miners, both, or neither? Take care of yourselves, take care of each other, and I will see you in the next video soon.